Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about backtesting in a bear market, and we'll show you some techniques we use at ORATS to help navigate these kind of environments. Matt, do you want to share a screen and get us started?
Absolutely, thanks. Yeah, it's been a pretty crazy market, as most people know, and backtesting is very important to identify strategies, see how they work, do analysis, and then some of these strategies, maybe hedging strategies that only do well or that have a big change in their returns if there's a lot going on in the market, especially what we've seen lately, a lot of bearishness, a lot of volatility. So, people ask us, how do we adjust or how do we interpret these back tests for different types of market environments? And that's what we're here to talk about today, Tyler.
All right, sounds good. Yeah, it's been a crazy market, so I'm excited to hear more insights. I think on our last episode, we talked about something similar, and we were sort of just heading into that bear market, and the market had dipped a lot, and we were talking about strategies, and you were talking about hedging things in your daily life and all that. So it's a pretty similar subject, but we're going to focus more on the back testing side of it today.
Yeah, and just to recap a little bit about that, the saying that I used to have when I backed traders, I was a market maker, and then personally backed market makers, was to hedge your happiness. People would kind of look at you curiously, but I would say, well, what do you want the market to do right now? They go, well, I want it to go up. Then I would say, well, you're long. So sell enough to where you're indifferent if it goes up or goes down. And then they kind of got that. And then, hedging your happiness or hedging what you want to have happen. So you're not hoping. The hope strategy, we always wanted to eliminate from our trading. And we always wanted to be somewhat hedged. There's sometimes when you have a position on that tends to work better up or down. But still, that would be, if you would ask them, how they felt about it if the market went up, they would generally, let's just say, be happy about it. And I would say, and even though their deltas might not show that, then I would say you're still long. So those are the types of things that we're talking about. Mm-hmm. And other things that we talked about were, so many things in your life, and I think you alluded to this, Tyler, are correlated to the market going up. And if the market goes down, it's usually pretty bad. There's, you're going to have inflation. There's going to be a lot of uncertainty out there. Your job security, if that, even if a entrepreneur, your job security might be a little bit more questionable after a precipitous fall in the market. So people are generally, without even having positions on, they're long the market. And often, obviously you have IRAs and all that type of thing, but and really, in a bad market condition, everything goes down. We're kind of seeing gold go up right now. We're seeing Bitcoin, hang in there. But in some bad environments, everything will go down, because what will happen is people will be losing money. They'll get margin calls. They'll have to sell anything. And so really, a lot of these studies that will look at, well, I'm hedged because I have this other long gold or whatever position on. Sometimes they don't hold. The only true position that hedges you are puts. And puts on kind of a related or very closely related asset as your long. So, if you're long SPY, it's the SPY puts. If you're long a lot of small companies, maybe it's the Russell or IWM ETF. So those are the things that we're talking about. And, then you might say, well, how, what do I do? Like, how do I backtest, and how do I know, or how do I kind of think about these backtests and think about the backtested strategies in these type of market environments? And that's what we're going to talk about today, Tyler.
All right, I'm excited. Thanks, Matt.
Yeah. So what I ran is, so our legacy backtester updates each day. So it's great, especially in this type of environment. We can check, and see how these specific types of strategies might behave or have behaved, recently. So I have a long put strategy that I think is pretty good. This is the legacy, so it's a 365 day. This is just a summary of it. 20 delta. So these are the types of puts that I like to have just all the time on, and staggered. Like, so if you don't stagger these, and we'll talk about how to do that with entry days. So you get in at certain points. If you don't stagger those, the market could just go up and up and up, and this 20 delta put might be a 2 delta because the market's gone up so much, and days have passed, that the chance of that put being in the money has reduced, and the delta has gone down, and so that creates a what we call path dependent backtest. And so we want to be using entry days and staggering those. Like, for a long term, you could do it every 30 days. For some trades that we recommend doing, almost every day, simulating an entry, because you don't want to miss a day, and have it kind of throw off the backtest. So that's one thing with these long puts that you want to look at. So I'll just pull this one up. I ran it in December, and it's one of the things that I have in my positions. It's you could favorite these types of strategies. It looks horrible, down 1.9%, but on these types of moves, it has a good blip. So you could see in 2008, you made 14%, market was down like 38%. You could see in other times, 2020, you made like 7-8% around that time. Market was down. I can't remember, but this is decent protection for that, because what happens is, not only does the market doesn't have to go down through the strike. It could just go towards a strike, and the vega goes up so much that you end up profiting on that. So, one of the things that we have on these types of strategies is a profit, and these are important. These kind of profit taking, and it doesn't have to be an all or none type thing. So if you like this type of put, you could have some at happens to be 200%. So we exit at 2.0, so it's 200% of profit. So you 2x your profit, and you get out of these puts. Now, some you might test 3x, 4x, but what happens in some cases is you'll miss it entirely. Meaning, it'll go up to 1.9x, or it'll go up to 2.9x, and you won't get out, and the market comes back, and you end up not monetizing. That's called these types of puts. So it makes sense so far, Tyler?
Yeah, I see that you ended it in November of 2024. I was kind of looking forward to seeing how it did in the tariff fiasco the last few weeks, because that's besides COVID, that's been the most recent blip that I think this is what we're kind of talking about here is the current bear market.
I sucked you in, Tyler. I had it run, so I ran it as of yesterday, or that's the latest that we could do.
Oh, there we go.
See, yeah, that we made 3%. Market down. It's hard to say, but like maybe 15%, if that. So a decent amount of coverage on your loss. I wouldn't call that, a truly, it probably got down as low as 20%, to make it into a bear market, but it's come back a bit. So now we're at 3.17. So that, this is something where, what I didn't look at.
Yeah, I was gonna say, you mentioned that it went down 20%, and I was gonna clarify if this was marginal or notional return, because I think the 3% return on this strategy is comparing it notionally. So it actually,
Oh yeah.
So if you're looking at just like apples to apples versus the market return, you actually made far more if you're looking at the margin return. So that would be interesting to rerun this with the margin, and maybe you can explain the difference between those two.
Yeah, so this is a case where I don't like to use margin because it's really kind of meaningless, because you're paying $10, $15 for a put, and that's not really what you're protecting. What you're protecting is your overall portfolio. So and what that means is, let's say I have 100 shares of SPY, $50,000 or whatever. You want to have the terms the same, which is to say the divisor of how well the strategy does. Mm-hmm. So when I said I made 3%, yeah, it's probably 300% of margin. It doesn't even compute, because that's not really the strategy. What you're really looking at is you're looking at what your kind of bleed is, how much it costs you. And we see it's about 2% a year, mm-hmm. But it really pops, and it can protect you in some really downtimes. And we've never had a huge bad downtime. People get a little overconfident, I believe, in the market, and just thinking that a bad thing could never happen. Well, bad things do happen, and you better have puts, because everything else is going to go down. So this is one thing that won't, and one thing that can protect you. So anyway, what we're kind of talking about, Tyler, is this exit strategy too. So these exit strategies that we've done here, you can see when and it's not the best UI, but so if we go back up to column headers, we see the exit date here, the exit stock price, the exit option price, and the expiration date. So if you see an expiration date, that's different from an exit date. So this is the same here, right? So that just expired worthless. But if you see it different, then that usually means that we've got out for a profit, or at least got out potentially. And if it's different, you got out usually at the exit, the early exit that triggered. So for example, we traded the June 20th, 2025, a year earlier, right? But we got out in April, on the 21st, when the market went down to 512. So we these are all the ones that we exited, all these profits down here. So these are all the early exits, and you could tell it gets in every month. So we've set entry days to every month. So that's I'll just show you what that looks like. So you set this thing called entry days, and you can set it at expiration, which is no real entry day, or you could set it at, I like to set it around 30 days, because sometimes I'll do that. I'll just put on a little bit of a trade, let some fall off, put on a little bit of trade, so it keeps the strikes kind of near where the market is. So
yeah, and I mean that makes sense when we're doing a trade that expires in a year.
Yeah.
Is there a way to, you mentioned sort of delta hitting a certain number? Is there a way to enter when the delta hits a certain number? Or I'd like to think that might be a little bit more repeatable or logical, I guess. But is there a way to do that?
Yeah, definitely. So this is entering on a profit and loss, right? So that's what we're doing now. But you could also enter, when the price gets to a certain level or when the delta gets to a certain level. So then, so you could definitely do that. I like to do that sometimes, but most people I like to do that for a lot of different types of strategies. But for this particular strategy, you got to think of what you're really hedging. What you're hedging is a massive loss. So, it's not really a delta thing. That might make a lot more sense. In, what I think you're thinking about is how do you maintain a kind of a credible, repeatable strategy? This really isn't that. This is more protecting your wallet. And so this is a kind of, people think of it in profit terms. And so that's why I like to do this for my puts is get out at a profit number. And again, you don't have to do everything at 200%. You could let some run depending on, at least you have, one of these old traders used to say puts are power. So when you have the puts, you could then kind of look at you have the luxury of looking at your whole position, and you could say, okay, I have a lot of puts. Everyone's panicking. I could even buy some now. I could buy some other stuff and maybe not exit right now, or exit the position. At the certain place. So yeah. So I think that looking at this long SPY put is very interesting to do. And what I've also done is I've run a short put spread. So I don't like and totally have never talked about about just selling cash covered puts. I think that's the dumbest thing. Like there's no such thing as cash covered puts. It's like you're not going to have cash in some of these situations. So cash secured puts, don't think of it like that. You always should have some type of a put as protection on these. If you're going to go for that type of strategy, you want to have that type of protection. So let's look at this short put spread again. I sometimes do this strategy, and I was looking at it back in December, and the overall average return for this strategy was 116, 1.16, and after this, it's gone down 20% to 0.91. But let's take a look at it. But that's not horrible, you know what I mean? Because you actually really benefited from having the put spread over the short put itself. So let's just, again, take a look at what happened to this, I think, more responsible way to sell puts. So, you lost, 2.25, 242. And you might remember that we made like 341 on the 20 delta long-term put, but this strategy is selling a 30 delta, buying a 15 delta 30 days out. So this is, if you were just selling the 30 delta without the long put, I can't imagine how much you probably lost, 10, 15% on this strategy as opposed to maybe the 5 that we lost on this so far. Does that make sense?
Yeah. I mean, it's in line with all the stuff you've been saying about always having long puts on and protecting your portfolio. So it makes sense, and you're very consistent.
Yeah, never be short units. And the units mean if you're short 100 shares, you need to be long a call against that. If you're long 100 shares, you need to be long a put against that. If you're short a put, you need to be long a put against that. So that's what short units mean. And again, I've been around so long that you just don't want to be. You don't want to have a lingering short unit out there, because it always comes back to bite you, it seems like. Even on the top, even on the upside, I had this, when I was just starting off trading on my own. So I had a backer, and then, I went off on my own. I had my own capital that I made, and, was all excited to go out my own. And we were having to sell this one company that I just started to trade. And like, they were coming in for calls, and I was having trouble getting long units. And then so the next day, a takeover was announced, and it was way up. And if it would have gone farther, I probably would have been out of business. So you never want to be, short units. I learned, luckily I traded out of it and did pretty well, but you never want to have to go through that. So never be short units.
Yeah. So, while we still got some time left here, I want to bring up what we've done in the Backtest Finder as well. And there's a few things there that I'd like for you to show before we end.
Sure. So I have the new Backtest Finder, Tyler, that has we're rerunning everything. So we could take a sneak peek at some of the things, but yeah, I mean, so the Backtest Finder has some interesting ways to look at things. Like we say, well, what was the annual return last year? What was the annual return last 5 years? What was the annual return, in bear markets, in bull markets? So that's the really cool thing I think that we've done with the Backtest Finder. Is there something that you thought of more specifically, Tyler?
I mean, yeah, it was mainly those filters, and we also have the performance stats of how you do. You can see the performance of how you do in bear markets and bull markets, and if you mouse over the little info icon, you can sort of see what factors into that calculation. But I think that's really interesting, and the ability to sort of filter those out when you're looking at strategies is kind of neat.
I think that's a really good point, because if you look at some of these strategies, like, how did it do during bear markets? Like, I don't want 4%. I want it to do 13%, right? So
Yeah.
then you kind of say, well, let's do this. Have it be in the market. So I'm going to go like 95% of the time, and then I'm also going to sort on annual return during bear markets. So then what we're going to do, it takes a while because there's millions of tests back there. But what we want to do is we want to see something that doesn't bleed too much. It doesn't cost too much. Okay, there's nothing right now. So let's just do.
Yeah, and the interesting thing here is that you're comparing all the SPY long puts.
Yeah.
The sorting might not be working on that. The new back.
Right. Oh, you're right. So let's do. Oh, you're right. We have to actually go. There's so many that they actually have to go in and sort those before we send it out to people. You're right, Tyler. But anyway, what I'm going to be looking for are strategies that do well in bear markets that don't have the poor overall performance. And those are the type of strategies that I really like, because you can be a bit nimble with with your strategy, but you want it to pay off in these bear markets that we test. So the way that we do it is we just isolate the poor performing markets, and then just total up how the things, the different strategies perform only in those times. And so then what you're seeing is, that 11%, for example, if it's going down 3% a year, it might not be worth it. I'm probably going to have to look at it a different way here. Let's see if we could trick it to come back to this.
Yeah, you might need to refresh. I don't know.
Anyway, but so we should also mention, announce that the Backtest Finder is being updated now. So it's such a massive database that it's expensive and cumbersome to update it. And again, this is the development version that we're because what we do is we go through and just make sure that the backtests actually are doing what are expected, and it has been pretty amazing. What you can do now on AWS, on cloud servers, etc. So there's the Iron Condor. So here's that long put, and so what we want to find with the long puts are okay. These aren't too bad, these end returns, but how you really have these on for the bear markets. And so, we like this one, 13%, right? So you could actually just click on that one and take a look at it. What you want is that kind of ratio. Like you want the ratio between you're not losing too much every year and you're making a lot on the bear markets when the bear markets come is what we're going to be looking for on this. So you lose, and then you make. So, but you're only losing about 1% a year, which is not bad for the amount that you make in these kind of bear market times.
Yeah. So are these new back tests that we're running going to include the tariff situation?
Yeah, we're gonna update those for April as soon as April is over.
Cool. Yeah, I'm excited.
Yeah, no, it's really great.
Yeah, I mean the Backtest Finder and just the Backtester in general are by far most loved features by a lot of our users. So these tools are very powerful.
Yeah, definitely. And so, kind of in closing, then what we like to talk about at ORATS is have these types of puts that don't cost that much, generally 1% a year, but that can respond in these bear markets. And also, if you're going to sell, find the ones that don't cost the most. So the opposite. So it's really cool to be able to, like, for example, a short put spread that doesn't cost as much in bear markets. So those are the types of things that we like to look for, Tyler.
All right. Yeah, that's great, Matt. I'm excited to see those new back tests in there and be able to use this table to its full advantage.
Definitely, yeah.
So yeah, unless you have anything else, Matt, I think that was a good show, very topical. It's important in backtesting to remember the importance of path dependency, to understand the difference between margin and notional returns, and then to look at things like long puts and obviously the spreads, and heed Matt's advice of hedging your happiness and always having some sort of long put on. So
it's not the sexiest thing to be long puts.
Yeah.
As a matter of fact, listen, it's been painful for me to always have my portfolios hedged, and be trading these and just seeing the, in my hedged portfolios go down and down. But now, like recently, they've made a lot of money, and so they've done what they're designed to do. So which feels a lot better, and that's what we're talking about here, Tyler.
Yeah. All right. Thanks, Matt. If you guys have any questions, just let us know in the comments, or you can shoot us an email at support@orats.com. We're happy to take any questions on the live show as well. If you guys are watching live, you can post a comment and we'll answer it on the show. So that's how we like to answer a lot of our support. If you have any specific questions about the dashboard or how to use it or a certain feature or anything like that. So thanks for the great show today, Matt. And thank you, Trader, for hosting. We'll see you guys again next Tuesday.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.